Hello, folks. Steve Lentz here with the Inside Wire here at Discover Options. It's October 31st, 2017. Happy Halloween, everyone. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Today, we are continuing along the general theme of doing our out of the money in the puts broken wing butterflies in a campaign style where we are leapfrogging two butterflies at a time. We put half on, then the other half, and then we leapfrog them around if the market keeps moving around. Today, well, since we spoke last, and in doing that backtesting previous, it was really bothering me that on every big up move, when the market would move up really far, the position would not make very much money and sometimes even be down. And, you know, when you think about it, the approach we've been taking is to put these on when the market condition is technically qualified, meaning primarily that it's above the 50-day moving average. We have some stochastic settings in there blended in, but generally we want to be above the 50. If it's below the 50, then we're typically 50 simple moving average. We're typically not putting these types of trades on because in that environment, it's more likely than normal that we will encounter a more active market than what the options are implying, which is a bad situation. So in that light, I decided to go back and recast a back test using zero debit broken wing butterflies. Also, I wanted to, you know, meander my way back to having a monthly presentation where we go over the strategies that we espouse in our mentoring curriculum, and you know, in coming in for a landing in terms of a monthly, month in, month out approach. This was going to be it, where we go right to that second month that has 60 days. Once a month, we put one on, assuming we begin the campaign, assuming that it's technically qualified. So in light of that, I wanted to begin that back test as well, that we could start a marketing effort with that. So in that light, let's go ahead and take a look at what we got here. So this was the best practices campaigning overview I went over last week, and I'm keeping it the same, only I'm adding in the red areas here, meaning that with exactly 60 days till expiration, and that's going to be in the second month expiry there, on the close of a technically qualified day, okay, we will initiate a zero debit. That means we have a positive cash flow. Okay, so we cannot have a debit coming out. The butterfly has to be put on with a positive cash flow, utilizing half our available capital. So every broken wing we put on, we have to make sure that the total position has no debit. It has to have a positive cash flow. Okay, so that's how we begin the campaign, and then when our trigger gets hit, we're going to initiate another zero debit broken wing butterfly. But we want to make sure that the two butterflies together have positive cash flow. That's the key. All right, now in this particular, I'll mention this, in this particular go-around, this second one sometimes ended up having a small negative because the first one had such a large positive, but the total together must be positive, okay? I'm thinking about recasting this again, making sure that the second one always has a positive. Okay, but that's not, and I thought of that right after I was wrapping this one up. I thought, oh boy, you know, this, because I would end up taking off the first one and the second one sitting there with a negative. And then you got to make up for it with your next one. So it's like, ugh, you know, so I'm thinking of that. Now we're getting into the minutia here, but that's fine. We've been at this a while, and which is good. You know, we're coming into we're polishing this up pretty good. Okay, and then we continue the leapfrog approach. So after we put on the second one, when a trigger gets hit, we remove the distant broken wing, and then we put on a more appropriately placed another zero debit, positive cash flow, broken wing butterfly. This is the leapfrogging thing. Okay? So I think you hopefully get the picture of this. Now, when we initiate the broken wing, the 60 days zero debit, we go right to that 60 days. Typically, it's going to be, what, the third Monday of the month, thereabouts. We keep our anchor strike the same. We're going to the first strike in the money by roughly 5 points or more. We're going to go to the delta that's negative 30 for our short put. And then, instead of going out of the money and using this out of the money long put as a delta adjuster, this is the debit adjuster. Okay, so we go far enough out of the money so that when we put this distant out of the money long put on, it flips it from being going from a debit to a credit, to a positive cash flow. You want to find that little spot there. And so we're not paying any attention to delta here. We're just going to go to the first strike out of the money that generates a positive cash flow. So instead of an entry debit of something under 5%, which is what our previous approach was, we require that the cash flow be positive. Instead of adjusting for delta, we go to the first strike that results in a total position of a positive cash flow. This will often, almost all the time, sometimes not, result in a slight positive position delta. We'll be delta long slightly. Okay, and because we're typically going farther out of the money for that long put, our margin requirements will be higher. Therefore, we're going to have to reduce the number of contracts that we do with this. Okay, we're going to round to the 25-point strikes, and again, as I mentioned, we will walk into risk, halvesies, so to speak. So here's an example. One moment here. All right. So with the SPX at 24.53, our anchor strikes at 24.60, so we're over 5 points in the money there. We come out to around as close to the minus 30 as we can. In this case, this was the 24.25. That worked out nice to have a 25-point strike there. And then we go farther out of the money, far enough so that when we go long these 14, we're ending up with a positive cash flow here of $800. Had I come one strike in like this at the 23.60 mark, that would have resulted in a debit of what, $100 or so. It was real, very small. But by going that extra strike further out, okay, we're paying less money out. That leaves a positive cash flow then of $801. Now this takes a bit of work because you're going to come out here and put this on, and you might start with a 10 lot, okay, and then you got to calculate, well, how many more can you put on and have it only take up half your capital. Again, I'm using $100,000, $50,000 on each set. Okay, each half, we're going to as close to 50,000 as we can. All right, so now we put this on, we take a look at it. This is typically how it is going to analyze out, is that you're going to have a T+0 line that's fairly flat. If you look real careful, though, it is slightly leaning long. It's sloped a little bit upward from left to right. The expiration line across here, okay, we were demanding that it be above the zero break-even line. Okay, before we were allowing it to be 5% under that. That's what was causing some problems in a big up move. We weren't making any money hardly, and sometimes even losing. And here, we're pretty assured that if the market moves up, all right, and implied volatility drops, we will be making money on the upside. And so big up moves should not give us too big of worry at all. Okay, so let's see what else. Oh, and let's zoom in on this. I want to show you a phenomenon here that's just wonderful, and this is really helped sell me on this whole approach. So here we're showing 5 lines, including T plus 0 and the expiration line 60 days out. If you look carefully, the T plus 0 line is leaning delta positive. It's going left, from left to right, slightly upward here. That means it's delta positive, and indeed it's delta positive roughly 15 or so. We can go back and take a look at the matrix. It's 16 and a half, at least in this particular calculation. When we go over here, I think it turned out to be like 15.7 or something. So, but look at this. As time goes on, the delta of the T plus line is going to shift from a delta positive. What do you think the delta is of this one out here at T plus 45? Okay, now it's leaning upwards from right to left. It's delta short. In that position, we would want the market to go down. So you can see here, let me just go to the next screen. I'm showing you the delta of each of these lines, T plus 0, 15, 30, and 45. At T plus 0, we're at plus 1592. Okay, and then 2 weeks later, we're at negative 13.76. All right, 30 days later, which is really going to be the cutoff point, we're at negative 70.55. So what you're seeing here is that time itself is providing an automatic adjustment to your delta, bringing it more towards delta neutral as time goes on, assuming the market doesn't move. See that? So now you can imagine then, if we were to go ahead and use the delta adjuster strike and start this thing out at delta 0, over the course of time, it's going to go from delta 0 to farther negative very quickly. And since we're putting these types of trades on typically in an uptrending market, those up days are going to hurt us, instead of really being okay or even helping slightly here at the beginning that you can see. So this is a dynamic here, I think, that's very valuable in this strategy, in that if you just put it on delta neutral, peg it right at 0, in time it's going to change, and it's going to go negative quicker when you do it that way. So there you go. We're starting out delta positive on these, and in time it just automatically adjusts towards neutral. The triggers to scale in the other half are the same as before. Instead of calculating expiration break even, okay, which was typically somewhere around here where that line was, now we're just taking that short strike itself, adding 1% to it, and that is our upside trigger. The downside trigger is the distant short strike, and our time requirements are still the same. Anything 35 or under, if we get hit, we're going to scale, and we're going to just remove the whole position at that point. Here's our triggers. Just to review, we take the anchor strike here, add 1% to it. So our scale in trigger will be here. Our scale in trigger on the downside will be right at the short strike. Okay. Same as before, only the anchor strike instead of the expiration break-even intersection there. In this case, the market went down, hit the short strike. Let's see, on June 27th. The previous date was June 19th, so it took about 8 days. Came down and hit that short strike. It took a week to do that, and so you can see we're not really losing money here because time decay did kick in. And so now what do we do? Okay, now what do we do? Well, we're going to go. We're going to put a long strike that's slightly in the money. We're going to come out here to the delta of 30. The way out here would be our adjuster, our debit adjuster strike. So when we put that on, you can see that we have the in the money anchor. We have our delta of minus 30 right there. And the way out there is our debit adjuster, so that we can maneuver this line here to be slightly above zero break even, plus 753. Okay? Now, before we had a positive cash flow of 801. Now it's at 753, so it looks like what? The one we just put on has a debit of 98, something like that. Instead of it being positive, it has a debit. And this is where I was going to maybe recast this thing yet for further refinement, in that this second scaled in, okay, needs to by itself perhaps be positive, have a positive cash flow. And that's what's missing here. Here we're looking at the total positioning positive. We'll see. I don't know. I'm still just sitting on whether to invest the time in chasing down that particular nuance. But you can see we're starting out, looks like a little bit delta long, very short delta long position, and then in time it moves into a delta short position where we would want the market to go down at that place. Time goes on though, June 27th to July 11th, the market wanders around, hits neither of our triggers, and we end up taking this off for roughly a 5% gain on our $100,000. So not too bad there. Okay, so with these new rules in place, where we're always have a positive cash flow, keeping all the other adjustments the same as before, let's just go through our rules real quick, and then we'll get to the results. Again, we're only going to initiate near the close of a technically qualified day. Okay, and that is anytime the underlying index is above the 50 simple moving average, except for when the 15-3 stochastic is above %D trending upward and still below 33. That's a very bullish situation, and often the market will blast off to the upside, or the market's crashed and then it's now hitting this condition and it's getting ready to go down yet again. But when it's below 33, okay, and we're below the 50, that's a market environment that can be fairly volatile when it's below 33 like that. So beware, but I think we get the picture here. All right, we're going to close the campaign. Again, we have our 2.5% stop, profit and loss stop before we scale in. Once we scale in, we're at 5 and 5. Okay, we'll leapfrog all the way up till 35 days, and then we stop. At 30 days, we get out. Contract size, we're adjusting it so it's 50,000 for each half as best as we can, and away we go with this. Again, and I don't know why I did this. I've already shown you guys this a billion times. Let's see. Brian says, with the new credit setup, I wonder if you would still need to leapfrog after upside moves. The increasingly negative delta over time would provide gains on any modest pullback with no risk to the upside. You know, Brian, I guess that you'd need a minimum level of a credit, right? The way I did it here is even if it was $1 of a positive cash flow, that qualified. So I just wanted to go to the last strike that was a negative, and then the next strike that produced a positive cash flow. That's the one I went with, regardless, without any attention paid to delta. Okay, but we are getting into the weeds here and polishing this, so I appreciate that. That might be an interesting nuance to require that the credit be X% of the capital required, something like that, because a positive of $1 is a heck of a lot different than having a positive like what I just showed you of 800. Okay, maybe require at least 1%. That would have been well, on 49,000. We're roughly $500, say. Okay, would have qualified. So got a noodle on that a little bit. I think it's a good thought, though. Then you could just maybe not adjust to the upside, just let it go, like you're saying. Another thought I have is that, and I know one of the butterfly folks out there, they do that reverse Harvey thing, where they roll in the longs of the butterfly, and then it lifts that right-hand line straight up. Let's go over and show you here. So here, let's go where's my thing here. So a reverse Harvey is once this thing starts making money, you basically then roll the 14. You could roll it in just one strike, and you could see you're going to gain $2 there. Now this is at the beginning, and then you're going to gain a little bit less here by rolling it up. But by doing that, the risk graph then, this blue line then, this flat blue line just rises straight up. Okay, and then this strike goes in, this strike comes in. So the butterfly's narrower. The long strikes come in a little bit, but this blue line over here lifts straight up. So you buy yourself then some room for it to keep going up. Now, when you do that, then your deltas go from, perhaps delta short. It becomes more delta positive when you do that reverse Harvey. But that's something that, and some of those other approaches, they just have the reverse Harvey laying there as an option for everybody to use at any time. My point is that upside adjustments, leapfrogging, would no longer be required for risk reduction purposes because of the initial credit. Upside adjustments would no longer be required. So if you add a second one, and then it keeps going up, you don't need to leapfrog at that point. Okay, so one could add the second one, and then presumably then your credit from the two of them would amount to enough that you would be happy on a further upside move after you put on the two. Right? That makes sense. Just have to make sure that the credit at the end of two of them adds up to something that you would be very comfortable with. What would that amount be? Any thoughts on that? Sure, but the market could also pull back with its negative delta. Right, and then you would make more money then. Right. Yep. Yep. So if you require a 1% and then another 1% on the second one, now you're at 2%. Well, 1%, it will be 1% of the, so it would be 1% of each half. It'd be 500 for the first one, 500 for the second one. You're sitting on $1,000 positive cash flow with 100,000 required. I think, but we really want to make more, ideally, than 1%. Well, but it'll come over that line. But that's something to play around with, for sure, and model it. Not sure we would need to require a minimum credit. Because when you look at it, the T plus 30 line here is a bit above the break of the expiration line. Okay, so, okay, well, I'm going to take a peek at that. That's something to definitely take a look at. Yep. Where are we here? Let me go back. Okay. I'm just going over the technical qualifications, the previous studies we did from other inside wires. Here's another look at the chart. You could see when we're below the 50, those don't qualify. Now what happened is in my back test, when we got to October of 2016, I couldn't do anything that month, right? Because there was nothing technically qualified. September, there was actually a bar here in September that made it just barely. We were able to put one on in September. Yeah, I mean, and that could happen. Certainly you could have that third Monday of the month come and you're in the, it's not qualified. And then I put in here that we're going to wait, till 50 days. We'll wait 10 calendar days to see if it ever gives us an opportunity to be technically qualified. Then we'll jump in. One of the times in the back test, it became technically qualified after about a week, and then we jumped in. Okay, I went over this. Let's look at the results quick. All right, so we started with 110,500 back on in February of 2016. Okay, and we finished up here today with how much was in. I think that last trade got taken out just yesterday in this back test. So out of 18 campaigns in the course of this time, we had 16 winners, 2 losers. Okay, about almost 90%. The average loser was 41-43. The average winner was 33-47. You could see a pretty clear edge here. Here's a list of the campaigns, open dates, and then the closing dates. And these are typically going to be the third Monday of each of these months, typically, somewhere around there. I don't know what that 8:30 is doing there. That doesn't, to go back and take a peek at that, that seems a bit odd. Maybe it was. Maybe it did work out. That's kind of weird. But you can see the 2 losers here. All in all, worked out pretty well. Here's the risk graph, or excuse me, the equity curve. The annualized return, 24.5 annualized. Keep in mind that we're putting these on once a month with 60 days to go, and if we get our initial 2.5% on that first half, we're out, and then we're going to sit around for a few weeks with no exposure in the market at all. So before, when we were doing this in the previous week's backtest last week, we had a continual campaign going on. We would get out with our gains, and if it was a technically qualified day, that same day, boom, we would jump right back in and initiate a new position. So in that way, we pretty much, as long as the market was technically qualified, we were pretty much always in as long as it was technically qualified. When we had to, close one out and open up another campaign. Here, we're doing one campaign a month, and even if it gets finished quickly, we're waiting around until the next initiation date. Okay? So, drawdown, yeah, just 3.6% max. Now here you're seeing data points on the 15th and 30th of every month. Certainly if had I taken every day, we could have had a drawdown a bit higher than that. I don't know how much. But, well, max drawdown 5184. Yeah, okay. Yeah, that's about right then. Anything else? Nope, that was it. That was it. All in all, pretty happy with the results. I think the approach has great merit. You're not going to score 100% returns a year doing it this way. But I think but consider how often you're actually trading this thing. I mean, you're putting it on and then putting on a scale, and then occasionally you're having to do a leapfrog. So you're averaging roughly, at most you're putting on 3 trades. I don't think there was one time where we had to do, let's see, we would put one on, scale in, make a leapfrog, get out. That was 4. The max, I think, was 4 trades in a campaign. Initiate, scale in, leapfrog once, get out. That was the most. Often it was initiate, scale in, get out. Occasionally it was initiate and then get out with your 2.5% profit, or one time it was a 2.5% loss, I believe. Something like that. Okay? All right. That is it for today. I'll be taking next week off. I'm traveling out of town. Going to go see some family in the Seattle area. But we'll be back 2 weeks from today with another topic and another back test. Okay? Awesome. Brian, thanks for joining us live. We'll talk to you in a few weeks. Take care. Bye-bye.